Financial crisis in the next 3 months. The devaluation of the US dollar is just the first step. Financial crisis in the next 3 months. The devaluation of the US dollar is just the first step. The real fatal blow will be triggered after 90 days, meaning at most 3 months from now. This is the final window the US government is giving us. If the US Federal Reserve and the rest of the world still refuse to compromise, the next step will be a financial crisis far more devastating than 2008. Just this month, stocks and bonds have already caused immense suffering for countless people. Yet, in less than 3 months, it may not just be stocks or bonds, but the collapse of all global assets. At that very moment, those of us holding hidden assets will have the opportunity to realize profits and buy at the market's bottom. What do I mean by this? Greetings, ladies and gentlemen, dear friends. You might forget your girlfriend's birthday or your wedding anniversary. At worst, you'd lose a few Hermes bags. But if you forget one critical day this year, the wealth you've worked so hard to build over the years could vanish in the blink of an eye. That day is the last day of June this year. Why? Because the $6.5 trillion debt the US borrowed previously will come due in June, precisely on the last day of the month. At that point, we'll see how the US plans to handle this debt. You might think, if the US doesn't pay its debt, what does that have to do with us? Why is it such an important day? In fact, many people still don't realize the severity of this situation. The $6.5 trillion debt the US must repay in June this year was largely borrowed during the pandemic. At that time, the economy was in decline, and the US stock market was halted multiple times. During that period, the Federal Reserve continuously expanded its balance sheet and pumped money into the market. That newly printed money was then lent to the US government and capitalists at near zero interest rates. This means the $6.5 trillion debt due in June has very low, almost negligible, interest rates. But here's the problem. Right now, the US Treasury only has a few $100 billion left, not enough to pay off the debt, so their only option is to borrow new debt to pay off the old debt. However, in recent years, the Fed has been raising interest rates. Currently, the US must borrow at an interest rate of about 4.5%. What does this mean? Let's make it simple. Suppose 5 years ago, I lent you $1 million, and I agreed that you only need to repay me $1 million in June this year with no interest. You'd be thrilled, right? For 5 years, you spent freely without worrying about interest. But now, you've spent all that money and can't pay me back. What do? You have to borrow $1 million from someone else to pay me, and now you owe that person. This is the concept of borrowing new debt to pay off old debt. The problem is, the new lender demands 4.5% annual interest. That means after 5 years, besides repaying the $1 million, you'll also owe over $200,000 in interest. Got it? US bonds work the same way. During the pandemic, the US borrowed at very low, near zero interest rates, so they spent freely. Now the US Treasury only has a few $100 billion left, and the $6.5 trillion debt is about to mature. The US is forced to face this repayment, but if they can't pay it off, what happens? They have no choice but to borrow more from others, using new debt to pay off the old. The problem is, new debt now comes with a 4.5% interest rate. This means that by June, the U.S. will shift from paying no interest to paying up to 4.5% interest annually. In other words, the U.S. is converting low-interest old debt into high-interest new debt. Currently, the U.S. Treasury only has a few $100 billion, which isn't enough for spending. It's estimated that by June, it will be completely depleted. At the same time, in June, the U.S. needs to repay the $6.5 trillion old debt. If they can't pay it off, they'll have to borrow new debt at a high 4.5% interest rate. The critical issue is this: even if the U.S. wants to borrow, there may not be anyone willing to lend anymore. Why? In the past, U.S. government bond interest rates were very low, yet countless people were still eager to lend their entire wealth to the U.S. If you had $1 million in assets, after 5 years, the U.S. would repay you $1.2 million, including principal and interest. This return couldn't keep up with inflation, but people still rushed to lend to the U.S. and buy U.S. bonds. Why? Because U.S. bonds always increased in value. In the past, when you lent $1 million to the U.S., they gave you a $1 million IOU, a U.S. government bond. You could take that bond to the market and sell it, sometimes for $1.1 million in a single transaction, because U.S. bond prices consistently rose. So many people wanted to lend to the U.S. The earlier you lent, the cheaper you could buy U.S. bonds. When the bond price rose, you could sell for a hefty profit. In other words, U.S. bonds were a speculative tool for profit. Look at this chart. If you bought U.S. bonds in 2014, i.e., FEEs lent money to the U.S. by May 2020, the value of your bonds had doubled. 6 years, doubled in value. And because so many people were eager to buy U.S. bonds, you never had to worry about finding a buyer. Plus, who's the debtor? The United States, the world's superpower. You didn't have to worry about them not repaying. Thus, U.S. government bonds have always been considered a risk-free asset. Here's a simple way to understand it. In the past, if you bought U.S. bonds and their value dropped, you could hold on to them, and the price would rise again even if it didn't. When they matured, you could demand repayment from the U.S. government. In other words, buying U.S. bonds was almost guaranteed not to lose money and could even double in 6 years. Because of this, many people used leverage to buy U.S. bonds. For example, today you have $1 million. You use that $1 million to buy U.S. bonds, then use those bonds as collateral to borrow $9,050 from a bank. You use that $9,050 from the dollars and keep repeating the process with 5 to 7 layers of leverage, starting with just $1 million. You could buy up to $56 million worth of U.S. bonds. But look closely at the chart. Since May 2020, U.S. bond prices have been steadily declining. Think about this today. You're a bank, and a customer brings $1 million in bonds to use as collateral to borrow $950,000. If the bond's value drops to $950,000, it's already at the margin. If it falls further to $900,000, do you think that customer would want to repay $950,000 to redeem a bond now worth only $900,000? Of course not. So, when bond prices start to drop, banks immediately demand repayment. Those who used 5 to 7 layers of leverage are aggressively pursued for debt repayment. They're forced to sell bonds to pay off debts, and this mass selling in just 3 years wiped out all the gains accumulated over the previous 6 years. Why have U.S. bonds fallen so drastically? because countries like China and Japan have been selling large amounts of U.S. bonds in recent years. The key point is this: people used to rush to buy U.S. bonds because their prices kept rising, but now U.S. bonds are continuously falling, entering a bear market, and even countries like China and Japan are selling them off en masse. In recent years, several U.S. banks collapsed because they held too many loss-making bonds. So would you still dare to buy U.S. bonds now? Currently, the U.S. Treasury is nearly empty and is preparing to borrow at high interest rates. But even with high interest rates, there may not be lenders willing to step in. So what can be done? U.S. bonds are now like a very old, very long house that could collapse at any moment. You could keep repairing and renovating it, but no matter how much you fix, it only improves the surface temporarily. The old foundation remains, and the risk of collapse persists. But that's okay, because there's another option: blow up the house and rebuild from scratch. In other words, if you're the U.S. government, you can keep trying to sustain U.S. bonds, or you can choose to die and be reborn. Blow up the entire U.S. economy, triggering a collapse of the global economy, then rise from the ashes, making the U.S. the fastest recovering nation, and rebuilding the house from the ground up. So, which would you choose? In 2008, the U.S. chose to blow up the house. Now, once again, they stand before a ticking time bomb that could ignite a global economic crisis. If you've experienced the despair of the 2008 financial crisis, or the panic when the U.S. stock market halted trading in 2020, you'll understand that those who think this doesn't concern them could lose all their wealth on the last day of June. But at the same time, those who grasp the script of this game early can seize wealth. If you don't want to be a victim of this game, and even want to leap up the social ladder, you can follow my channel, because I plan to provide more information for you in the future. And if you're worried about forgetting after listening, wasting your time, you can like this video to automatically save it to your playlist, making it easy to revisit and follow later. So, what must the U.S. government do to solve the problem of swapping low-interest debt for high-interest debt, and the issue of running out of money to spend? There's only one answer. The U.S. elites must step in to save the day. That means the Federal Reserve must turn on the money printer, use the printed money to buy U.S. bonds, and lend it to the U.S. government for spending. Moreover, interest rates must be lowered, ideally to zip. But here's the problem. Why would the Fed help the U.S. government? Because if no one buys U.S. bonds, the U.S. won't be able to repay the $6.5 trillion, and at that point, their only option is to declare bankruptcy, admitting that those IOUs are just worthless paper. Everyone who lent money to the U.S. would lose it all, unable to redeem their dollars. And if a major nation like the U.S. can blatantly default, the entire world would immediately flee from the U.S. dollar, switching to other assets. It's simple. Think of it like a bank. Why did I deposit money in your bank? Because I thought my money was safer with you than at home. But now, your bank declares bankruptcy, meaning I might not get my money back. Wouldn't I rush to withdraw my money? And why do we use the U.S. dollar? Because I feel holding your dollars is safer than holding my country's currency. For example, if you're Ukrainian, your country is ravaged by war. But as long as you hold U.S. dollars, you can still preserve your wealth. Most importantly, the U.S. dollar is tied to U.S. government bonds. To buy U.S. bonds, you need U.S. dollars, meaning you must hold dollars to lend to the U.S. government. But now, what happens? The U.S. government defaults, and stops repaying. The bonds I hold instantly become worthless. Would I still want to hold US dollars? Are your dollars still safe? A bank's bankruptcy creates conflict. A US government default would do the same. How do people react? They sell off US dollars en masse, switching to other safe assets. Once the US dollar is no longer backed by US bonds and the US government defaults, the dollar would face an unprecedented sell-off, turning into worthless paper, and all assets in the US would become valueless. Thus, the Federal Reserve cannot afford not to step in. If they don't, the wealth and assets of the capitalist elites behind the Fed would also vanish into thin air. In other words, whether the Fed expands its balance sheet or prints money to save US bonds, even a question: would the capitalists want to perish with the US? Moreover, this year, the Fed has already stopped shrinking its balance sheet, meaning it stopped withdrawing money. The next step is to expand the balance sheet, print money, and pump it back into the market. So, saving US bonds is a certainty. But how might the Fed choose to save them? Option 1. I can expand the balance sheet, print money to buy US government bonds. But I don't have to lower interest rates. I can keep the high 4.5% rate. Some say 4.5% is high. Come on, folks. Before, the US government borrowed at near zero interest rates. Now it's 4.5%. That's over 4 times the cost. And they're borrowing trillions of dollars. Even 1% interest is a massive amount. But if you're borrowing just a few tens of thousands, 5% interest is nothing. So, if the Fed doesn't lower interest rates annually, the US government will be forever enslaved to the capitalists behind the Fed. Simply put, American citizens earn money, pay taxes to the government, and the government uses that money to pay high interest to the Fed and the tycoons holding short-term bonds. If the US dollar maintains such high interest rates, more and more US businesses won't survive and will go bankrupt. Even the US government borrows at 4.5% interest. So if you're a business issuing bonds, your interest rates are even higher, right? If you can't afford such high interest, you go bankrupt. And if you go bankrupt, many people lose jobs, leading to unemployment. When people don't spend, the economy stagnates, leading to a collapse of both stocks and bonds. At that point, people like Warren Buffett, who sold off US stocks early and hold piles of cash, can buy assets at fire sale prices. Buffett isn't just holding cash, but also safe assets, short-term US bonds, from 3 months to 1 year. By then, the US government will have to repay Buffett both principal and high interest. In other words, Buffett not only lends to the US government at high interest. When he wants to buy, he can convert short-term bonds to dollars and hunt for cheap assets. This is what we mentioned earlier. There's an old, long house, US bonds. You can repair and upgrade it, meaning let the Fed back it. But it remains old and long, and no one will buy it. Interest rates are still set by the Fed, a noose in the hands of capitalists to strangle the US. That's why Trump has never asked the Fed to expand its balance sheet or print money. He's only demanded one thing: lower interest rates immediately. But the Fed has been clear: I'll lower them. So what options does the US government have? Only one: blow up the house. Let US bonds collapse, US stocks collapse, and drag the US dollar down with them. Why? To force the Fed not only to print money, but to print it on a massive scale and at high speed while slashing interest rates to the lowest possible level. Because when the market collapses, Even a slight delay or weak intervention won't save it. And this bomb is global tariffs. Smarter people will see that whether the Fed doesn't lower rates and prints money slowly, or Trump forces them to lower rates and print money rapidly, the outcome is the same. U.S. assets must undergo a sharp decline, even a collapse. But you know what? Every collapse is a moment of wealth redistribution. In the 2008 financial crisis, some went bankrupt and jumped off buildings, while others bought at the bottom and became rich. The 2020 pandemic wiped out small retail investors, but hedge funds easily tripled their profits. This year's crisis will be the last chance for ordinary people to change their lives. Why do so many people lose money when markets crash? Those without stocks blindly try to catch the bottom, only to buy midway down the slope. Those holding stocks either panic and sell at the bottom or stubbornly hold on, hoping to recover, but fail. As a result, you miss the chance to profit from both the sharp decline and the strong rebound. If you're still brainwashed by irresponsible strategies like hold long-term, and it'll rise again, your wealth will be crushed by this era. So, you must learn to identify the peak signals before the market collapses, to lock in profits in time and seize opportunities when the trend reverses, leading to a sharp decline. The key is this: the Fed hasn't lowered interest rates yet, but that doesn't mean they won't when a collapse happens. If we look only at results, U.S. stocks, bonds, and the dollar are all crashing simultaneously. But gold prices are soaring. Isn't this following the pre-scripted playbook? Step 1. The U.S. dollar devalues. Suppose there's a house worth $1 trillion. Does that sound expensive? Most people would think so. But if I told you $1 trillion is equivalent to one Vietnamese dong, meaning you could buy the house for just one dong, would you still think it's expensive? Similarly, when the dollar devalues, the house's value drops. If the dollar devalues, the debt's value drops too. The U.S. is due to repay $6.5 trillion in June, and the dollar index has already lost 10% of its value. Doesn't that mean the U.S. has already reduced its debt by 1/10? And that's just the current result. If the dollar keeps devaluing from now until June, the U.S. will pay even less when the debt matures. That's just the first step. So, how do you make the dollar devalue? Trigger a stock market crisis. This time, the dollar's sharp devaluation is due to a U.S. stock market crash, causing global capital to flow out of the U.S. and into other countries. Thus, the world rushes to sell dollars, driving down its value. If the U.S. wants to pay less debt in June, don't they need to trigger another stock market crash, or even two, between now and then? Step 2. Push gold prices up. This makes both the dollar and global currencies lose value against gold. Why? In the first step, when the dollar devalues, other countries' currencies rise against it. But if the dollar and those currencies all lose value against gold, it means gold prices soar. Is a rising gold price good or bad for the U.S.? Many don't know that the U.S. holds over 8,000 tons of gold, more than the next 3 countries combined. That 8,000 tons is just the U.S.'s own gold. Many other countries, like Germany, store half their gold at the U.S. Federal Reserve, including foreign gold deposits. The total is about 15,000 tons, and that's data from a few months ago. Recently, the U.S. imposed gold import tariffs, prompting the world to rush gold from the UK to the U.S. So, if gold prices soar, is that good or bad for the U.S.? It's good because the gold assets the U.S. holds increase in value. When the world stops buying U.S. bonds, it's fine. They can buy gold, which is also a U.S. asset. In other words, in the first step, the U.S. lets the dollar devalue to pay less debt to the world. But the U.S. doesn't just have dollars, it has gold. In the second step, rising gold prices help the U.S. offset losses from the dollar. One side falls, the other rises, balancing overall. I analyzed this plan in detail in a video 2 months ago. You can watch it later. Step 3. Use tariffs to trigger a global asset and currency collapse. Combine this with the Fed expanding its balance sheet and printing money to rescue the market, then redirect capital from gold back to U.S. assets. What does this mean? Let's review the timeline to make it clear. The U.S. must repay $6.5 trillion in June, while tariff increases are delayed by 90 days, meaning until July. This implies the task of devaluing the dollar to reduce debt payments will end after the U.S. settles its debt in June. So, as mentioned earlier, if the U.S. stock market crashes again, it's likely to happen around June. By July, when tariff hikes restart, global assets and currencies could collapse again. In other words, a new global economic crisis could erupt around July, with global assets heavily discounted and sold off. As mentioned, the Fed hasn't lowered interest rates yet, but that doesn't mean they won't during a crisis. If the 2008 and 2020 scenarios repeat, the Fed will not only expand its balance sheet and pump money into the financial system, but may also lend near zero interest rates, enabling U.S. capitalists to buy stocks and assets at the bottom. Then, U.S. stocks and assets will recover strongly, and the U.S. economy will rebound faster than the rest of the world. At that point, other nations will continue selling their assets cheaply to buy U.S. assets with dollars. Thus, global currencies and assets will devalue further, while the U.S. can push gold prices down to redirect capital from gold back to the dollar. U.S. stocks and bonds. U.S. assets will then rise from the ashes and surge again. Step 4. The simplest. U.S. capitalists can take profits at the peak, then use their revalued dollars to buy global assets being sold off cheaply. This is how you blow up the old house and build a new one. You might think all this is just my baseless speculation, but that's fine. Let's look at history. Economists have pointed out that when the Fed expands its balance sheet and pumps money, the money supply increases and money loses value, right? But look at reality. Before the 2008 financial crisis, the dollar fell sharply. After the crisis, the Fed expanded its balance sheet, printed massive amounts of money, and cut interest rates, yet the dollar rose again. Similarly, before the 2020 pandemic stock market crash, the dollar fell sharply, but after the market collapsed, the Fed printed money limitlessly and slashed rates to near zero, and the dollar surged again. Why? Because history shows that before every U.S. crisis, U.S. capitalists sell their assets first, move money abroad, and inflate asset bubbles in other countries. At that time, the dollar devalues and other currencies rise. But when the dollar and U.S. assets become dirt cheap, U.S. capitalists return to buy at the bottom. The Fed rescues the market by lending at near zero rates, pushing U.S. asset prices up again. When the world collapses in a financial crisis, But U.S. assets rise and recover. Global capital is forced to flood back to the U.S., aggressively buying dollars. Meanwhile, global assets continue to be sold off, and the dollar keeps rising. In the end, capitalists can use their revalued dollars to buy global assets being sold off cheaply. So, if things are increasingly resembling history, and since last year we've been accumulating gold, yen, and other safe haven assets, and now those assets are continuously rising while the dollar keeps falling, it at least shows our first half investment strategy was correct. For the second half, let's watch how the U.S. government handles debt repayment in June and July, and whether they trigger another global asset collapse. If they do, we can follow the trend, sell gold and yen at their peak, switch to devalued dollars, and wait for the Fed to expand its balance sheet, pump money, and lend at near zero rates. Then, the dollar and U.S. assets will likely rise again. At that point, I'll choose the right time to buy U.S. assets again. And in the end, when U.S. assets have risen, we'll assess whether to invest in other countries' devalued assets. Even if no crisis happens, and the opportunity doesn't come, we lose nothing, right? We just withdraw capital and reallocate our portfolio. So, if you don't want to miss future market opportunities, you need to prepare now. Align your perspective with mine. Understand the investment mindset and methods I share, and make them your own. Don't wait until the moment arrives to ask, should I enter now? Is this asset still worth buying? I'm stuck with losses. What now? Because once the opportunity passes, who knows how many years you'll have to wait again. Recently, global conditions have only grown more volatile. But due to time constraints, I'll stop here. I share free knowledge on becoming wealthy, an entrepreneur, an investor, and achieving financial freedom. If you don't want to miss out, follow my channel, turn on notifications, and share this video widely. I sincerely wish everyone who likes this video achieves financial freedom soon. If you find even 1 or 2 helpful insights in today's video that improve your life, I'm already fulfilled. I'm FortuneCraft, and I'll see you next time.